Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. We've got Jeff Hirsch returning to the show today. Jeff is an expert on stock market seasonality and the editor of the famous Stock Traders Almanac. You might remember we had him on a few months ago, and he made some great calls then. If you missed that episode, definitely go back and check it out after this. But before we talk to Jeff, it's Friday, the markets are closed, so let's take a quick look at how this week played out. All right, so 3 of the 4 major indices closed higher this week. Small caps led with the Russell 2000 gaining nearly 4%. The Dow lagged, ending pretty much flat on the week. The S&P 500 rose a little more than 1.5% to close at its highest weekly close in 5 months. We managed to get above that 4,100 level, which was resistance from the September-December highs. If we can hold above that 4,100 level in the near term, the next upside objective will be those August highs around 4,300. Now, let's take a quick look at how the sectors performed this week. 8 of the 11 sectors closed higher. Communications led, rising more than 5%. Energy lagged by a decent margin, dropping nearly 6%. Anyways, that's enough for me. Let's talk to Jeff. Jeff, welcome back to the show. Always a pleasure to talk to you.
What's up, Patrick? Good to be here. We had a good chat last time.
Oh, we sure did. And listen, the bar is kind of high. Because the last time you were here, it was, I think, the very end of September, maybe beginning of October, but point is right near the lows. And it was a pretty popular time to be bearish back then, but you were kind of singing a pretty optimistic tune. You talked about how October is known for being a bear market killer, especially in midterm election years, which we were in. And you talked about how we were kind of in that sweet spot of the 4-year presidential cycle. And history is definitely rhyming a little bit because the S&P 500's up double digits since you were last here about 4 months ago. And here we are today. We're recording this on Thursday, February 2nd. We're kicking off a fresh month. So I want to kick it off, start off the conversation with February seasonality. So break down the month of February for us. What's the typical month look like?
Typically, it's the weak link in the best 6 months of the year, November through April. But pre-election year February's do quite a bit better, as do the whole year. So you would think kind of the rising tide, sort of thesis there that all months do a little bit better in pre-election years. And small caps and NASDAQ tech stocks, which are bouncing right now for other underlying reasons, a lot of oversold action there, but that seems to be where the strength is. So instead of the end of the month fading as it does in average years, pre-election year February's are quite strong, up close to 3% on the on Russell 2000 small caps and a NASDAQ composite.
Yeah, and as far as the intra-month, you're saying, if you look at it over like a 50, since 1950, you used to see kind of a drop off, strength kind of in the beginning.
S&P's negative for the month since 1950. The other months, Russell 2000's always been better, up 1%. The other indexes are kind of single digit, fractional gains. But you get in the pre-election year, and this is the street spot. We talked about this. You just mentioned it last fall, and you're in Q1 of pre-election year, and that really impacts February's seasonal pattern, and it doesn't really trail off. It kind of has a early month, to the middle of the month rise, and then it sort of just drifts sideways a little bit. Doesn't quite sell off like it normally does.
Yeah, and what do you think of maybe? Do you think maybe we could have pulled some gains from February's performance in January, because we had such a strong January last month? Do you think maybe that has an impact at all?
Not on the first two trading days so far. I mean, it can in other years, but when you're in this, sweet spot after a midterm bear market and you're looking at some pretty big average gains during this first quarter of the pre-election year, I'm not so concerned, that it's going to pull gains out of February. Uh, strong Januaries are bullish inherently for the market. That means that things are looking pretty good for the year as far as the market overall is concerned. So I'm not concerned it's going to pull away from any gains in February. I mean, that doesn't mean we're not going to have a little chop here in Q1. We still have some, economic releases and headwinds that could give people pause. The Fed maybe didn't seem to do that yesterday. I mean, we're looking for a little chop in Q1, and part of my biggest fear, which we can talk about later, is that maybe I'm not bullish enough.
Yeah, and I like that little reminder you gave us, that we're in the midst of that Q1 of pre-election years, which I don't know if it's the strongest, but it's definitely a very
It's the
strong quarter in
strongest
that
quarter
4 year.
of the four of all of the 16 quarters in the 4 year cycle, and it's
Wow.
also in the midst of that. I mean, you probably even it says it in your almanac there, but I mean, I'm sure it does. Uh, but the 3 quarter combo from midterm Q4 to pre-election Q2 is just the best. I mean, it's up like 30% for Nasdaq, 29.3 on average, about 20% for Dow and S&P. So yeah, maybe we have half of that, in the S&P so far, almost in January. I think we're up about almost 9% on this on today's trading, but yeah, I mean there's a lot of there's people who are coming over to the bullish side, but there's still a lot of people a lot of skeptics out there that are going to get have a little FOMO, I guess they call it, right?
Yeah, I mean, we're only 2 days into February, and I can't tell you what the performance is off the top of my head, but I'd imagine we're up at least a couple percent so far just over these
Yeah,
past 2 days. So already starting it
for
off on the
sure.
right foot, right?
Yep.
So listen, one of the reasons I wanted to have you on this week was because the turn of the year, between December and January, we get a lot of interesting seasonality indicators and seasonal data. And you might, some of our viewers might be familiar with some of them, but you have what's called the January Trifecta, which is, of course, the combination of 3 different seasonal indicators. So I want to break down each one, and then we can kind of bring them all together to talk about the trifecta at the end. But let's start off with that first one, the Santa Claus rally. It's kind of a misunderstood one, right? Why don't you break that one down for us and tell us how it
Misunderstood.
performed?
Yeah, for sure. And created by my father, Yale Hirsch, back in 72, along with the third one, we're going to talk about the January barometer, all his inventions. Santa Claus Rally is simply the last 5 trading days of the year and the first 2 of the new year. Everyone thinks that the Santa Claus Rally is any year-end rally. On December 24th, people were saying, "Oh, there's no Santa Claus Rally." Well, it's because it started that day, man. So, and it's really not this trading strategy that everyone wants it to be, where it's like, "Oh, where's the rally? Should we buy it?" No, it's if it doesn't show up, it's an indication that things are amiss on Wall Street. Hence my father's famous line that if Santa Claus should fail to call, bears may come, to Broad and Wall. And for those young people out there who don't know, the New York Stock Exchange is at the intersection of Broad and Wall Streets.
Yeah, I mean, it does seem like people almost take it for granted, right? And you start hearing people talking about it at the very beginning of December, and we have all of December pretty much to get through before that period actually starts. Like you said, it's the
And
last
and
five
the
days of December and the first 2 in the new year.
and the beginning of December is notoriously weak. There's a lot of tax loss selling there, and people forget about that. And that's sort of in the January effect, not to be confused with the January barometer, really begins now, which is the small cap effect. Small caps outperform, and that materialized. Again, when that happens, that's just a sign of health in the market. Russell 2000 has been a bit of a leader off the low and even off the June lows last year. So that's encouraging. And then there's the first 5 days indicator, which is something that's been around for a long time. We've covered it and carried it in the almanac for, almost all 56 years of them. And that's just an old, opening of the year. Some people think it's the first week, but it's the first 5 trading days. And that was up. Then we had the full month January barometer, Yale's invention. As January goes, so goes the year. It's been, shown it's been given a lot of skepticism over the years because, the bias of all years is up, and we include the January gains in the full year gains. But we've looked at it with the remaining 11 months, and we've compared all the other months, and it still has predictive power. But over the years, we've seen, at least the last couple of decades, and you've seen it, January has not been as great as it used to be. Average gains have come down. There's been a lot of selling, a lot of concerns there, and it's been a profit-taking month. And they've also moved the State of the Union address a little bit further out. It kind of helps. I mean, that's part of the reason the January barometer works, is because of the lame duck amendment, 20th Amendment to the Constitution that brought all newly elected Congress people into office, a month or so, or 2 months after they were elected in November. They used to come in the following December. Remember, back in the old days, people didn't have like planes to get to Washington. They would take a horse or whatever down the trail from Boston to DC, So,
oh man,
the 20th Amendment to the Constitution moved, and also Inauguration Day used to be in March. So it moved new Congresses convening to January and new presidents being inaugurated in January. And there was a tradition up until recently where you had these State of the Union addresses, which really sets the priorities and agendas for the year for the country. And you've also got everybody and their brother, including me and you, making forecasts and outlooks, end of December into January. So you've got everyone laying out their position and what they think, including the government, the politicians, the Wall Street's reaction to what's going on down in Washington. And the January barometer was born. And it doesn't go back to 1896 with the Dow, and it doesn't really start until about 1938, which wasn't ratified until 35, I believe, by all the states. And then, if you remember, that was the Depression. We had the most lopsided Democratic margins in Congress during those years in the beginning. Didn't really impact what was going on. Nothing really changed. So it doesn't really begin until then. And but recently, as I was saying, January's not been as strong, and there's been a bunch of errors in the barometer. So back in 2013, we combined these three into the January indicator trifecta, and that's what we've hit this year.
So the trifecta, you started off Santa Claus rally, and we barely eked that one out. I think just on one of the last days, it was down, and then we maybe the last day it went up, and so it ended up about 0.8%. So we managed to gain with that one. The first 5 days was nicely positive. It was up, I think, 1.4%. And then the January barometer was very positive, 6.18% for the month of January. So all three of those are positive. My question is, how rare is that to see all three of those seasonal indicators positive like that, like a 3 for 3 on the trifecta?
I mean, it's not rare. It's less than 50% of the time, going back to 1950. I think Ned Davis Research they did a piece which I was, mentioned or talked about they went back to, I think, 1930 or 20-something when the S&P data begins. There was like 38 of 94. Here we have 31 years going back to 1950. So what's that, 73? So that's about a little less than half.
Okay.
Not rare.
Not rare, but not majority.
Maybe. Say again?
Not something you see very often, but maybe not rare either, right?
But there's still, I mean, you're looking at 31 years since 1950 is a pretty decent chunk of the years. And it's up 90% of the time for the years. 28 of those 31 years, averaging 17.5% for the S&P. But again, taking January out and just looking at the last 11 months of the year, February, still up at 83% of the time. 27 of 31, 12.3%. So
go ahead.
No. So it's pretty bullish. And I think, you look at different types of indicators when you're looking at analyzing a stock. Sometimes you look at different time frames, but when you layer a few things on there, it adds some conviction to the conclusion analysis. So that's what we have here is a combination of indicators, not too many to dilute it, but a select few or handful that confirm, support, combined to give you an even better indication.
Yeah, and of course, this year is pretty unusual because we're coming off the worst year since 2008, since the great financial crisis. We had a true bear market last year. And
Yep.
some would argue that we're still in it. But
I would
my
argue we're
question
not.
is, my question is, does the trifecta perform any different when you have a bear market in the prior year?
Oh yeah, even better.
Oh yeah?
Much better. But you're asking about rare. That's a little rarer
Okay.
to have the trifecta hit with a bear market and a bear market low right out of the almanac bear market bull and bear market page and like page 130 or something. Only 13 times. And the full years are all up, every single one of them, all 13, and all double digits, and some big numbers in there. So 13 and 0, up 22.1% on average. Last 11 months, still up 13 and 0. Couple of single digit gains, but mostly higher single digit there. Only one about 6.5. There's a couple of eights in there. 6.8% on average. Pretty solid for the S&P to gain, 17% over the next 11 months after being up in January and hitting the trifecta. So, I mean, this combination is rare, but the fact that we had a midterm year bear market and an October bottom, of course, it remains to be seen. We're going to have to make new highs for all the skeptics and bears to be convinced that we're not going to make a new low before we make a new high. But I think you might agree with me now that it's looking. The bulls sort of have the ball, as our buddy Art Cashin would say, or the elder statesman of the group. All of us analysts and such out there. So that's not as rare, but the combo is a little more rare,
So in this table, you basically have it's happened 13 prior times where you have the trifecta 3 for 3, right? After a bear market.
After
and
a bear market
it's
bottom.
never been down the full year.
Never.
And
never
those
been
words
down
are
the last
dangerous,
11
right?
months. What's that?
Always and never are very dangerous words, I feel like,
Yeah,
in trading and
we get
investing.
scared when we have those something and O stats. I think we talked about it last time, where you have the best 6 months in midterm years are up 18 and 0 since 1950. And that was again one of those things like, yeah, well, maybe this is the year that we break the streak. But
Yeah. Well, I like to say that just because I think a lot of people hear stats like that and they think of it as a certainty. And it's like, there's 13, the sample size is 13. So, it's totally possible that something comes in and completely changes all that data. But the point is, it's certainly not bearish, right? There's
it's not
information in
bearish.
that. Yeah.
I mean, I think the only things that could really derail this bull market are probably the Fed not doing, or continuing to hike beyond 5% or so. There might be another quarter or two left. We've been saying since last fall that, and since the last, we'd get, after the 75 in December, we'd get a quarter in February and a quarter in March. If we don't get that, that could derail things. Inflation, if it doesn't continue to mitigate, that'll be an issue. Those are the main things. There's the exogenous ones. There's Ukraine, there's Russia, there's China, Taiwan, there's the Mideast, there's all those hotspots that could do something and, hurt our streak here. But everything else is looking pretty bullish. Even some of the, I know we're more technicians here, but, being the chart report guy, but on the fundamental side of things, earnings are forecasted to hit their trough in the mid-year. It comes from S&P Capital IQ. There's things that are turning. We look at other disciplines other than seasonality and technicals, but let's keep going. What else did you want to ask me?
Well, so that was actually my next question is what could, I know you don't look at seasonality alone. You look at other things, price, you mentioned the Fed, things like that.
Market
And I don't want
internals.
to talk too much about the Fed, but I will ask you, what do you make of yesterday's reaction to the Fed?
Bullish. I mean, I'm not sure what people were so concerned about. I mean, I was a little bit wondering why the market was down so much. I don't know if there was a bunch of shorting going on. They were trying to do something, with the markets, but we got the quarter point everyone was expecting and hoping for. The tone was, yeah, we're not done yet, but we just went from 75 to 25. I mean, when the market turned around in the afternoon after his comments, I mean, I heard him say a couple more, and I think I even texted my partner that. I mean, I could look it up on my phone, but that was the line that I was like, here we go. Now the market's going to rally. So, I mean, we're nearing the end, and everyone's realizing it. And now he's listening to the market, and he didn't beat back the market like he did at Jackson Hole. Things have changed. Inflation's come down. We're up like what 3%, or something, or 2.5% since the Jackson Hole numbers.
Yeah.
So I think the market reacted, cheering that we're making some progress, and we'll probably not hit any major recession. I think we have one last year. I mean, you see Jeremy Siegel today, or hear any of what he was saying?
No. What'd he say?
He's the professor. He's been around for a long time. He's usually on the right side of things. He's looking for 15 to 20%. That was my base case of my annual forecast. Now I'm looking for 15 to 20. My biggest fear is that, I'm underestimating how much the market can go. I'm looking at a chart here of the bear markets in the slide deck that I have, which I'll share with you, and you can put it up, in the show here. Yep. The table you have of mine of the bear market years, the trifecta years after bear markets, we ran a seasonal chart of Dow, S&P, and NASDAQ. 1 year seasonal pattern of those 3 years, and NASDAQ's up almost 32%.
Oh,
in
wow.
years after in these 13 years. Actually, it's not all 13 because NASDAQ's it's about half of them, about 7
Wait,
of them.
say that again. It's up after what?
In years that we hit the January indicator trifecta, after a bear market year, NASDAQ averages almost 32% gain.
Oh, wow.
Yeah, it's screaming. I mean,
yeah.
The sweet spot is 29.3%. That's the Q4 through Q2.
Wow.
So there's we're gonna have some bumps, we're gonna have some dips, but this is that wall of worry. There's a couple other things I want to share. The pre-election year pattern. I think it's in the Outlook in the Almanac on page you can see that there, page 10, 12.
The pre-election year, so like 2023, those tend to be the strongest of the 4 years.
It is the strongest, totally the strongest. Yeah, it's like the one that's double digits out of all 4. You can see,
and that's consistent. That's consistent with last year, because last year was terrible year, worst year in a decade, and it's also on average the worst year within that 4-year presidential cycle as well. So if we're staying consistent.
Market, the bottom picker's paradise, as Yale called it. So I mean, I wouldn't be as bullish now if we didn't have that bear market last year.
Yeah. Oh, that's
it sets up. I mean, the pre-election years that weren't great were years that didn't have corrections in the prior year or two. If you get back into your 23 Almanac, there's a whole page that lists, all the, page 30 or something, like 28 this year. It's got, the list of all the different, I don't know if you can, that's glary. Anyway,
I got one more
all
to
the
ask
things
you
that
about.
happened. And all the years that pre-election year was not great were years that It didn't follow midterm bears or sell-offs in one of the first 2 years.
Yeah, so one
So
other one, and you
yeah.
haven't heard too many people talking about it because it didn't happen this year, but wonder if you could just touch on it briefly, is that December midpoint or the December low indicator. And could you talk
Mhm.
about that?
Oh, sure. That's like the fourth early year indicator. Um, I think Jeff saw it.
Yeah,
He
used to.
brought it to our attention years ago. I haven't spoken to Jeff in a while. He's a great technician, great analyst. I miss seeing his commentary as much.
Yeah, he's
Uh,
retired now.
yeah, he's retired, but I still would think him and some of the other guys, it'd be nice to hear what they had to say.
Yeah.
He brought that to our attention. It was an old thing from Lucian, I think it was Lucian Hooper. It's on page 40 or something in the book. Things move around a little bit, but it's basically if the Dow closes below its December closing low in the first quarter, you got to watch out.
Yeah, and of course you didn't hear that this year because we didn't. We held above it.
But
But
what
I
did we do last year?
I was gonna say I remember past years where we did break that and you start hearing about that December low indicator. So it's a
And
good
it was
thing that
the
we didn't
19th.
see it this year. Again, there's information in the fact that things didn't show up, right?
Yes, like the Santa Claus rally.
Yeah. And I love that you
That's a
reiterated that earlier, that it's more if it doesn't happen, that's the signal rather than this, let's take it for granted. Oh, December should be great kind of thing. I mean, yeah, December is usually good, but when we're talking about the Santa Claus rally, last 5 days of December, first two of the new year. And again, it's if
and
it
it's
doesn't,
bad when it doesn't show up.
right.
Whereas when the December low indicator doesn't show up, it's good.
Yep. Well, listen, Jeff, I think we covered it all. But to our viewers, definitely go pick up a copy of your Stock Traders Almanac. I mentioned it last time. I put it on my Christmas list every year. You can buy it at just about any major book retailer, Amazon, Barnes and Noble, what have you. Although I'm a little mad at Barnes and Noble because they got me my copy a little later than I wanted. But anyway, Jeff, thank you. Go ahead.
Next time, just call me for it.
I should. Well, listen, thank you so much for coming on the show, and we'll definitely have you back soon.
Appreciate it, Patrick. Thanks again.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.